Breaking this hour after its big blockbuster debut on Friday, shares of Lyft right now, we're trading down some 12%, $68.88 a piece. And this after the ride-hailing service tumbled as much as 11% earlier, falling below the stock's IPO price in its first full day trading as a public company. So the stock trading as low as, well, these are session lows at this point, 68.79. Before that, we were looking at 69.12 a share, and that's more than 20% down from its Friday intraday high of 88.60. So in one day, you're in a bear market already. So the question is, can Lyft reverse course and live up to the hype, or will it be another snap where it just can't handle the public pressure? Our next guest company has worked with one out of every 3 unicorns, and big names like Spotify, Fitbit, WhatsApp, and Sonos have used his platform. We have EquityZen CEO Atish Davda joining us in a Fox Business exclusive. So you have to take a look at the share price of Lyft. Now, what you do is a little bit different because you basically help private placement, the people that can get in before the IPO.
That's right.
So you got in at a $15 billion valuation, if not better and lower than that. But for the IPO purchases, you're in at 24 billion or so. So people are thinking there's a lot of hype, not a lot of follow through.
Look, the average investor usually waits until the company goes public, which means you're probably buying at least at the pop, if not higher. And those values were, anywhere from, I think they went up as high as $88 a share. That's a big climb down to $69. But comparing it to Snap, I think, is going a little too far.
Why? They're very similar in the sense that they were losing money going into their IPO. They had a big pop on their first day, and they couldn't carry through because the numbers in the business didn't justify it.
Yeah, I would say it's like comparing apples with dragon fruit, where Snap is a dragon fruit. You're talking about a company that, everyone says, oh my God, it sounds really cool, it's sexy, it's very exotic. But when you try it, you say, I don't know what the fuss is all about. And I think that's similar with Snap, because with Lyft, you have a $2 billion revenue company growing 100% year over year. With Snap, you have a company that went public with $400 million in revenue, but $500 million in losses.
Right. Okay. But you're also losing $900 million a year in Lyft. And you're not going to be, by the way, probably profitable until 2022, 2023, according to Guggenheim today. And they're saying you might be a little bit overvalued, especially if you're looking at a $1.2 billion loss in 2019.
That's right. But if you take a look at the trajectory that Lyft is demonstrating with its net loss margin, you talk about Lyft losing 200% of its revenue 2 years ago. Today, that number is less than 50%. You take a look at Uber, however, who has not been able to maintain that trajectory quite at the same level. And I think you start to see that Lyft is prioritizing a line of sight to profitability. Lyft is actively trying to make sure that its revenue growth stays constant, meaning it continues to grow really quickly, but its losses shrink over time. Right. And I think that's something we just never saw with Snap. Perfect example, last year, Snap made less money than Lyft and spent more money than Lyft. I should say it lost more money than Lyft, actually.
Okay, but Lyft is a pure play. Let's be honest. It's a ride-hailing company, still subsidizing $2 per every ride. And some have said that, ride-hailing is a winner-take-all kind of market. You've seen that internationally in China, in Southeast Asia, also recently in the Middle East as well. So, with these type of losses and this type of stock reaction, do you think Lyft's going to be around in a few years?
Yeah, look, I would say in a winner-take-all market, when it's something as fundamental as transportation, unless we see this thing to becoming a utility down the road, right? Unless we see the government taking over and converting this into buses and subways. Oh wait, we know what that looks like and what that turns out to be. I absolutely do think Lyft is going to find its way towards profitability. It might not be in 2 years, but we're talking about a 10-year time horizon. I would just say, I spent a little bit of time on a farm growing up. I would say if you plant a seed into the ground, you don't dig it up every 2 days to see how it's doing. You let it run its course, and you either believe in it or you don't, and either way is fine.
Now, do you think Uber is looking at this, thinking about pricing themselves and thinking, okay, let's do something a little bit more reasonable instead of going $10 billion above their last private round of valuations?
Yeah, look, Uber started off doing what Lyft's entire business is today, But unlike Lyft, that's only in North America, you have Uber that's kind of has a global footprint. It's got 9 other business lines, including Uber Eats.
Yeah.
And
self-driving, you name it. I mean, they've got a big branch of businesses.
They're basically a General Electric before even becoming a public company. And so I think they are very different companies, but I think Lyft's example gives Uber good data points to really tweak it right at the last minute.
Okay, Atish, thank you so much. Good to see you.
Good to be here.
Atish Davda.